It's with the market slide, what's the outlook for venture? I'm a little biased, obviously, but I think this is going to be the most interesting panel that you attend today, so kudos to all you. Unlike Alistair, I'm going to have a chair here. One, I'm lazier than him. Two, I just had foot surgery, and I got pretty cool socks on, so I want to show those off. You can check them out later. A couple things before we get into the panel. I don't know if you know, but this is a historic event that you're witnessing right now. Not since, I think it was 1988, when the Academy of Arts in New York honored Jules, the Pulitzer Prize winning cartoonist for The Village Voice, and Jules Holland, lead singer of Squeeze, that two guys named Jules were on the same stage. So it's big, it's big. All right, I wanted to set a little bit of a backdrop. Again, the title is With the Market Slide, What's the Outlook for Venture? Our friends over at Fenwick & West came out with a report just a couple of days ago, so I'm going to take theirs, but I did just give them credit. So according to Fenwick & West, there were 148 VC financings in the Bay Area during the first quarter of 2016. 78% of those financings were up rounds, 11% were flat, and 11% were down rounds. This was a small decline from Q4 2015, which had 82% up rounds, 12% down rounds, and 6% flat. The average price increase of financings, that's price per share, in Q1 2016 compared to the company's prior financing. So again, we're comparing financings that happened in Q1 versus their previous financing, whenever those happened. It's up 53% on a price per share basis, which is a decline from 70% in the previous quarter. And this is the lowest amount since Q1 2012. Now, let's meet our panelists. I thought I wouldn't do them justice, so I'm going to have them introduce themselves. We'll go left to right. TX, take it away.
Hi, my name is TX Zhuo. I'm the managing partner at Karlin Ventures. We are a C-stage venture fund based out of Los Angeles, but we invest both in San Francisco as well as in LA. We've been around for about 4 years now. Have made 42 investments. The sectors we focus on are enterprise software, marketplaces, and fintech.
My name's Erik. Is this on? Erik Rannala from Mucker Capital. We're a C-stage venture fund. We also run an accelerator called Mucker Lab. We're based in LA and focused principally on Southern California, but invest all over the place, and focused sector-wise on internet-enabled software and services.
And I'm Jules, number two. I'm Jules Maltz from IVP. We're a late-stage venture firm based here in Silicon Valley, offices in San Francisco and in Menlo Park. Been around for 36 years, currently investing in a $1.4 billion late-stage only fund. Some of our historical investments were Twitter, when invested in the third round there, Snapchat, second round, Supercell on the mobile gaming side, Tanium, Slack, Dropbox on the enterprise side.
Keep going. I'm Alex Rosen. I'm a partner at IDG Ventures. IDG is a little bit of a funny beast in the venture world, where we have an anchor investment from a media company called IDG, but the majority of our capital comes from outside, so we're an independent boutique firm. We focus on Series A, so I guess I should be sitting in the middle between those two guys and the late stage investor. We've been around for about 18 years. We're investing $120 million fund. We split roughly half and half between consumer and enterprise, and the sweet spot for us is Series A, $2 to $5 million into the company.
Great, thanks guys. So again, the topic of this discussion is with the market slide, what's the outlook for venture? First question, is there a market slide?
Not yet.
Define market slide.
You define market slide. What are we seeing? What are you guys seeing as far as deal flow, as far as valuations, as far as everything in your world to determine a market slide?
I mean, at the late stage, there's a huge market slide. I mean, it's night and day between what the environment was 6 months ago and what it is now. I mean, the IPO market is effectively closed. You're not seeing any tech companies go public. And it doesn't seem like it's going to open in the next, month or two. You're seeing big companies fail. I mean, the Theranos scandal, what happened with Lending Club on the fintech side, not a failure, but just massive decline in price. Very little liquidity out in the market. So there's still green shoots. There's still great companies fundamentally doing well and growing their businesses, but just from a financing environment, valuation environment, opportunity for great companies to raise capital at cheap prices, that's just not out there. So what you're seeing is a lot of the great companies are are hunkering down, they're getting to profitability, or they're raising more debt. They're not out there raising equity capital right now, and because of that, I think we're in this kind of weird time where a lot of the data that you're quoting is historical, things that happened or were negotiated in Q4 end up getting reported in Q1. But I think we're really in for a much lower, a more of a slide, and I think we'll maybe potentially even return to the environment at the late stage where a flat round is the new up. That would be successful if you can get a flat round.
Yeah, I mean, I think there's no question, even at the seed or Series A stage, things have turned dramatically, in the past like 6 to 9 months. Now, it's a cyclical business, so I guess we all shouldn't be surprised. But, especially considering for the past several years, things have been going kind of up, and up. It shouldn't be a surprise that things started going down a little bit. So I think we see it valuation-wise for sure, just the amount of time it's taking companies to raise follow-on rounds. So like our portfolio companies that are raising Series A, Series B, later rounds, it's definitely different than it was, call it 9 months ago. But having said that, Q1 was a kind of record-breaking quarter for venture funds raising capital. So there's a lot of capital out there that needs to get spent, and I think it will get spent. I think prices are just different, and the expectations are different for what people are looking for.
And I think just to add to that, I think what has happened is a couple of implications. I think one is that Series A investors used to invest based a lot of momentum. I think that has changed back to investing based on metrics. So when people think about Series A round, I think you really have to hit those milestones that you set for yourself. So I think a track, at least for the seed level, is pre-seed rounds. I think these were super hot in 2014 or 15, where companies used to raise enough runway for 6 to 9 months, prove a little bit of traction, and expect to raise a Series A round. I think that's going away. So when it comes to looking at deals at the seed stage, we are pretty conscious of companies at least raising enough capital for 18 and not 24 months these days.
So I'm going to sound like a grumpy old man. I think we haven't even begun to see a market slide yet. I think that we human beings have really short memory, so we just remember what happened a year or two ago in general. At least we overweight that. So 2014, 2015 were off the charts, fucking spectacular years on any metric, right? Dollars in, valuations, and that's what we remember. So, the numbers he quoted from Fenwick, right? Of course, that's Fenwick's, database of the rounds they financed. So what was the number? 10%, 11% were down financings? Right? So I was looking from another law firm at the data from 2009. 55% of financings in Q1 of 2009 were down financings. 55%, right? When that starts to happen, then we'll have a market slide. Until that has happened, we're still in la la land. I think that, people are complaining about, not complaining, but sort of saying, evaluations on Series A have gone from, 20 to 18. Like, that's still good prices, an average 55%, increase. Pretty awesome.
Okay, so note to self, don't approach Alex for financing.
No, just the opposite. I think it's great now. I think it's going to be shitty. It's going to be
Everyone call
shitty in a
Alex.
couple of years.
The audience is primarily early stage companies. I think a lot of them, with a panel like this, they want to know what kind of advice to give them for approaching you guys. And again, I'm really happy about the panel we have from the earliest stage guys up through the growth stage guys. So it's a really great perspective. So if you guys can address some advice on approaching you guys about investments. And let's kind of go from that spectrum. Let's start with TX and Erik and Alex and then Jules.
Well, I think in general, at every stage, expectations have gone up and the bar has gone up. And TX mentioned this, but I think it's a lot harder now to raise, even at the seed stage, frankly, without some data or metrics or something to look at, whereas I think that wasn't true, 9 months ago. So I think everyone's looking for, fundamentals and metrics now, even at the seed stage.
I think the more you can prove, to Erik's point, whether it's a working product, a couple of customers that are using your product and actually can show us real metrics, I think that's a lot better. I think gone are the days where we seed investors who actually invest in a business plan. So, but I think at the end of the day, like, the best companies still get funded. So if you have a great business, I think you can raise money anytime. Whether it's a good or bad market, I think you just have to work a little bit harder, but the round will get done.
I guess I'll go next. So I think that two things are happening. Somebody already said that good companies can raise money anytime, and that's absolutely the case. I think the difference right now is that the Me 2, Me 3, Me 4 versions of some I'll pick on food delivery sector just because we all use them and there are a ton of companies in that sector. So I think the toughest businesses to get funded now, almost regardless of what their metrics look like, are companies that have 10, 20, 30, competitors or lookalike businesses. So, we invested primarily Series A, some at Series Seed. We will absolutely finance a founder whom we know, on a PowerPoint. We will, finance Series A that has a little bit of traction, but it really has to be a business that stands out on its own merits and is unique, as opposed to competing with, 30 other companies out there.
Yeah, and I think one of the things sometimes entrepreneurs do wrong, or just they think about, how do I approach venture capitalists? Like I need to somehow like pitch a venture capitalist, convince them to give me money. And actually the best way to do it is to have the venture capitalist pitching you, right? So how do you actually change that dynamic? And one way to change it is just execute on your business, become a top 100 mobile app, or get some traction in the market and have customers, and get a PR story written about you in some publication, get a venture capitalist to somehow discover you, and then they're coming after you, and then all of a sudden the power dynamic just dramatically changes, because we get approached all the time by people saying, hey, can you fund our business? And more than 60% of our investments are ones where we've gone out to the company and approached them because we know their metrics are going well. And so there's a funny quote, an early stage mentor of mine, venture capitalist, says to me is if you ask a venture capitalist for money, you get advice. They tell you what's wrong in your business. But if you ask them for advice, you don't ask them for money, you don't always get money, but you might, right? So actually changing the dynamic and having it be more of a, hey, can you give me some advice on this? Or I heard this other company, what do you think about a partnership with this? And then show them some amazing metrics. All of a sudden they're going to be trying to convince you to take money if you've got great metrics. So it all starts with that, but just going the cold pitch to a venture capitalist, your success rate's going to be so low.
I think just to add to that, I think just as words of encouragement, I think valuation till you sell your company is just a vanity metric, so it shouldn't really matter to you. I think what you should focus on is the quality of your business, how fast you're growing, how well you're doing. I mean, we had one company in our portfolio that just got a down round, and the founders were so upset. It's like, we're doing so well, and it took a while to convince them, but I think valuation, it's just a small component of your business. So as long as you have the money and you continue to build a great business, one day you'll succeed.
Great advice all around. Thanks, guys. So what industries are getting you excited these days? What are you guys looking at today and in the future, more importantly? Anybody?
Sure. So I think I can sort of think about businesses to invest in two categories. Ones that are making improvements on things that we already have today, and things that are starting completely new markets. So in the completely new markets, there's been a lot of talk about AR, VR, MR, sort of augmented reality, mixed reality, virtual reality. I think there are probably more opportunities, in my view, on the business side as opposed to the consumer side of that in the near term. So that's one area we're spending some time. And then in the first category of businesses that are improving what we have, I think there are so many amazing opportunities on the mobile side for businesses that are yet to be funded. I mean, when was the last time somebody had an awesome experience with a business mobile app that was fast and it was productive and it was awesome, right? I mean, that doesn't exist yet. And the more applications like that are going to be deployed, I think they're going to be great opportunities for companies to get started, for ventures to get funded.
Anybody else?
I think if you think about a lot of industries, especially the brick and mortar ones, I think the role of the middleman is going away. I think the equation will become service provider, direct to consumer. So I think marketplaces is an increasingly important category. That's something we've been focused on. Platforms that enable sellers to get in direct contact with consumers, and consumers to do likewise. So I think that will continue to be a growing sector within the startup ecosystem. But more importantly, I think you have to look at contribution metrics. I think a lot of marketplaces are consumer driven, so they might be a good service to a consumer, but they're not venture backable businesses, just because you never get to profitability. So I think as we as venture investors think about investing in marketplaces, I think unit economics are pretty important.
So flip side of that question, what are some things that maybe were front and center a year ago, 2 years ago, and now you don't want to touch with a 10-foot ball from an industry perspective?
I think Y Combinator put out some really cool data of like in their pitches, like what were the really popular terms. You guys can all Google it, and what were the ones that like they don't see in their pitches anymore. And so one of the ones that like completely dropped off was Bitcoin. That was, there was so much promise around that. That's really changed. Every company or every new industry kind of goes through a hype cycle, and Gartner, the research firm, is kind of famous for this. But a lot of companies, whenever there's a new industry out there, whether it's Bitcoin or probably VR, AR now, like the first kind of year or two goes through this massive like hype cycle of this thing's going to be the next greatest thing. It's sort of like the internet in 1997 or 8. And then people realize that like it doesn't actually come to fruition. And I think Bitcoin's in this, what they call kind of the trough of despair right now. And what will be interesting is, the great industries end up eventually, the internet did this, but eventually it becomes ubiquitous, and there are real businesses built out of them. And so I think it's really interesting just to see different industries go through those cycles. We're monitoring VR and AR right now, but it's probably like the hottest thing, but no companies are making like real revenue, and it's a lot of hype right now. And so I think one of the nice things about being a late stage investor is you tend to miss the hype cycle, both on the up and on the down, and you kind of wait until it gets towards that traction area. But there's a lot of stuff, whether it's Internet of Things, Bitcoin, that just, it feels like there's been hype around it over the last couple of years, and now it's just not as popular.
Yeah, I think we tend to try to avoid getting sucked into whatever's hot at the moment, just because I think by the time it gets really hot, one of two things could be going on. A lot of the interesting opportunities have already happened, and then with things like AR and VR, it's still so early in terms of like that market or that industry. We're taking a lot of risk at the seed stage. We're taking kind of execution risk, team risk, a bunch of risk. So when the market itself is in its infancy, I think on things like AR, VR, we would wait a little longer to see where the market's going, and then still invest in very early stage companies there. But then broadly, we look across, B2B or enterprise and consumer, and really try to look at it on a company by company basis. Obviously, watching where trends are going and watching where new areas are happening, but we're not heavily thesis driven, where we're kind of market mapping the world and then deciding, okay, we're going to scour the earth for this kind of VR company. We tend to just watch what's going on and then company by company make decisions.
I think at least for the B2B enterprise, I think what's happening as companies start to tighten their belts is that they'll still invest in technology that helps them drive revenue, but sort of things that are part of the cost line become a lower priority these days. So we're thinking about HR onboarding, you're thinking about sort of back office tools. These become less of a priority. It's not to say they're not important, but when you have to prioritize spend within the organization, everything goes towards driving your top line or driving your margins.
Sounds like I'll be the only one funding VR companies on this panel for a while, so send it my way.
There you go. Line up now, back at Alex. So we talked a bit about metrics. TX mentioned that in historically, or I shouldn't say historically, over the last, during this cycle, it was all about managing for growth. But lately we've been hearing a little bit more about the old P word, profits. How much are you guys talking about profit in board meetings and in investment decisions?
We've definitely shifted. Not in a major way, but last year we did 18 investments, which is a pretty high year for us, and 1/3 of them were profitable. Most years it's about 10 to 20%. So we definitely shifted a bit of our investing towards more profitable companies, which I think was prudent. I think the key thing in the venture market is growth, right? And so I worry that if people shift all the way to profits, the worst thing actually you can have is like a business that's doing somewhere between a few $1 million of revenue and $10 or $15 million of revenue and flat or declining and not growing. And even if it's profitable, you're just kind of stuck as an entrepreneur. I guess it's not the worst thing in the world. But failing, at least you can just do your next thing and try to figure it out, and maybe you hit it big. But if you're sort of working for 10 or 15 years on something that's stuck, and even if you've got it profitable, it's just really difficult to ultimately have a success, at least a venture-backed success. So I think most companies have to figure out, how do I grow as fast as possible, but how do I do it in an efficient way that allows me to continue to raise capital in the future? And if you're burning $30 or $50 or $80 million, like, you better be Uber, Airbnb, or some astronomical success, because if you're not going to get funded. And so that's what's going to happen to a lot of the delivery companies, the on-demand companies that just don't fundamentally have great businesses. But if you're a company that's only burning, $5 million a year, $10 million a year, you're fine. Just grow as fast as you can, keep it up. There'll be money for you, and so don't over-index on profitability too soon.
So, I mean, we're literally at the opposite end of the spectrum, stage-wise. So we don't really focus on profitability. Very seldom are companies at the seed stage profitable, but we do focus a lot on unit economics, and looking for favorable or positive unit economics. We want companies, after they raise capital, to have some path to to being self-sufficient, or not requiring lots and lots of capital to keep going. But the goal is not necessarily profitability. We focus on, them being able to get self-sufficient at some point in time, just in terms of fundraising risk, not in terms of being a profitable business at that stage.
Yeah, I think that talking about profit, you really have to put it in context of what size of the company and what stage. I mean, for seed or Series A investors, if a company has no revenue or 1 million or 5 million in revenue, nobody's going to be talking about profit, right? So maybe it's not the P word, maybe it's the P2P, right? It's the path to profitability. Like how much, at what scale can you get to profitability? And if that scale is $200 million, then there's a problem. If you can't get to profitability at 20, 30, 40, and you choose not to because Jules shows up with a really big check because you're growing so fast, that's great, but you have to rely on that. So the profitability is the backup that you need to be able to fall upon when you have a certain size.
So everybody in the room, including the folks up on the stage, ultimately is looking for an exit in every investment we make, or every investment as we grow our company. So what do you consider a good exit? Feel free to pick your metric, whether it's time frame, whether it's multiple. What do you consider a good exit?
A really, really big one.
Everybody write that one down? You got that? Yeah. Are there any metrics that you're looking at? Where you
we look at, so we're a $1.4 billion fund, so we got to have some big outcomes, and so we want to make 3 to 5 times our money in 3 to 5 years is sort of our return model for that to work. And if we do that across, our fund, then we potentially could be a 3x fund, and and 2+x net, after carry and all that stuff. So really good compared to any metric that our investors can get into. But because of that, the math is like really staggering actually for our stage. So if we own on average like 5% of a company, right, and we want to eventually have a fund that returns $5 billion, that means we need to have $100 billion of market value exits, right? And so we've been really lucky. We were in Twitter early and Snapchat early, and so I think we may have some impressive ones, but like 100 billion means you have to have some just astronomical successes. And so the thing that actually is the worst for us is again, not the worst for us, but we want entrepreneurs to go long. We don't want them to sell early. Every good company gets acquisition offers multiple times a year, or even multiple times, at prices higher than last round that would make the individual entrepreneur really individually wealthy. And so we actually need entrepreneurs to say no to those and to go long and hopefully try to build some really big businesses. So the math is staggering. We know that, and we try to look for the entrepreneurs that are predisposed to take more risk.
And I guess at the seed stage, your hit rate, by definition, is going to be a lot lower. So when we think about exits, I think a single exit should at least have the chance to return half our fund. So if you think about it, for like a $40 million fund, a great exit would return about $20 million. We own usually about 5% of these companies. So if you back solve the numbers, this would imply like about $500 million exit would be phenomenal for us.
Yeah, likewise, we're targeting companies that could return, when we think about it, could return our whole fund, but we realize that not every company is going to be that. So, just some companies are genetically predisposed to be smaller, and you don't really know that when you're investing at the seed stage. We look a lot at the market size and, and a lot of different factors to make a judgment as to whether that could end up being a really large company. And it just, the reality is it just doesn't always end up that way. So, so sometimes it's really relative to the company. Sometimes, you know, a $50 million exit's a really good exit for a particular company once you see how it evolves.
We tend to think of exits in terms of multiple of capital as opposed to sort of the annual IRR. You know, there's an old saying in venture capital that you raise money on your IRR, but you eat cash in cash. So you need to have a high enough IRR that you can raise funds from your investors, but ultimately it's the multiple of capital that matters. And again, sort of you can use the standard, you know, venture results to back solve a little bit. So if you have a $100 million fund, a third of your investments go to zero, a third of your investments end up being break even, a third of your investments are winners. So $30 million of investments has to return, you know, pick a number where you have a 3x fund, 4x fund, so that's 300 million, 400 million. So the answer mathematically is you need to have at least, you know, a 10x on your winners in order for an early stage venture fund to be a good fund.
Great insight, thanks. Last couple of minutes, I wanted to open it up to the audience for questions.
It's hard, you know. I mean, you're looking for people that are like on the border between crazy, but but also like visionary and everything. And you actually kind of want someone who's on that line. And if you look at a lot of entrepreneurs, they're irrational, right? Because like if you actually like someone who's like I'm an MBA, I don't like MBAs make tough entrepreneurs sometimes because like they're quite rational, right? It's like economically the right thing to do is to go work at Google for 20 years, like that's your best economic path. Like to go start a startup, like your chances of success are so low that to do that is even crazy. And so most people inherently, just entrepreneurs, have a little bit of that. But the ones that I think say no to those outcomes are ones where they have a vision and a mission for what they want to see created in the world. And usually that vision involves an independent company that they want to build. And so success for them would not be doing this within Facebook or doing this in Google, or they would have just joined those companies. It would be, you know, I want to either, you know, see my name up in the, you know, up with all the greats in history, or I want to like have this iconic IPO that people talk about, but they have like something that's maybe beyond something that has kind of really unique passion. And you don't know going in, because every entrepreneur says they have that, and then when they get an offer, then you know, because the ones who accept it are, you know, it's like, oh, this wasn't, you know, and I've had that happen a couple times where you go, hey, you know, this entrepreneur wasn't really shooting for that huge outcome, and that's fine. But and you hope they will the next time. So, yeah.
And I guess two telltale signs that we see is that we have a group of founders in our portfolio who keep asking us to give them more salaries, and that's usually a red flag for us. And the second thing is pretty simple. I think when we take pitches, there are a group of entrepreneurs who come to us and say, we could sell our company for 200 million, so this is an amazing opportunity. So right there, I know that the number in their mind is probably 50 million, because when they say 200, it's probably 50. So those are the kind of entrepreneurs we try to avoid.
We stay pretty clean, which is really interesting. So everyone talks about, oh, the terms have really changed. There's like a bunch of ratchets and multiple liquidation preferences, all this stuff. And like for whatever reason, just philosophically as a firm, like we tend to have very clean terms, meaning like standard, you know, 1x non-participating preferred stock, which is kind of the same thing a Series A investor would get, but we just get it at a, you know, at the Series C round. So we really haven't seen that. I think the weaker your position is, like, and if you're trying to prop up a valuation, you definitely accept those things. It's funny, I was meeting the other week with like, because I'm actually not that busy compared to what I was a year ago. It's like our deal flows in terms of number of deals is probably down about 30 to 40% in terms of number of investments. We're still investing, not as rapidly. But the people that are really busy, this person I met with was on the debt side. And if you're a venture debt provider or you're providing kind of pre-IPO mezz debt for companies, like taking debt is a great way to not face the music of what my real valuation is. And the debt folks are busier than ever. So actually, it's actually really interesting. So I think you're going to see like first go to debt, and then if you really need equity, you may have to accept those terms. But I don't know if the Fenwick data posted any like major change in terms. So we're not seeing it.
Yeah, I mean, at the seed and Series A stage, we haven't really seen either. Valuations are down quite a bit, and I think it's harder to raise, but we haven't seen anything in terms of like crazy liquidation preferences or anything like that yet. But if it gets worse, I think you will.
I think one small change that I've seen in a bull market, I think some investors are willing to buy common stock. We've seen that change a lot now. Almost no one's willing to buy common stock because of the lack of downside protection.
The one, I would generally agree with the comments. I would say the one change in terms that I've seen in our companies that are raising Series B, Series C, is that there are more cases of senior liquidation preference for the new money coming in, as opposed to pari passu, which is what has been for the last 5 or 6 years. But I'm not seeing multiple liquidation preferences or ratchets or repricing or anything like that.
We have time for one more question. Anybody want to be that last one? All questions have been answered. Gentlemen, thank you very much.
Thank you.
Thank you.